Okay, we'd like to call the finance meeting to order, please. Doug, are there any public speakers today?
No, sir, no public speakers today.
Okay, but we do have a guest from the governor's office, and I'd like to welcome the governor's Deputy Secretary for Transportation, Karen Ray, who would like to say a few words to the Finance Committee meeting. So, Karen, it's all yours.
Thank you, Chairman, and so nice to actually have somebody that helps me with audio because I often fail Audio 101. It is a great honor to be here and join you today. Someone told me this is a rare occurrence that someone from the governor's office actually comes and joins you, but I think it's actually a very strong comment about the importance of the MTA to the economy of New York State. And so I want to just take a moment to just reinforce some of the things that happened just a week ago, a little over a week ago. Many of you have heard of them, and thanks to the good work of Bob Ferran and Nuria Fernandez and Linda Kleinbaum, who've worked tirelessly with us as we put together our state budget. But I think we have to start with the fact that Senator Cuomo, or Governor Cuomo, and the leadership of the Senate and the House have worked very hard to ensure that we have a functional base to work on in New York State. And the work that happened last year, both in the original session and then the extraordinary session that occurred in December, really set a base on which we could then move forward and make some of the really important decisions that you saw in our budget document that came out just a few weeks ago. The strong leadership is based on building a sustainable model that's going to last beyond this fiscal year. It's really challenging agencies across the state to not only bring fiscal discipline but also bring reform to the conversation. And during these challenging times, leaders like Governor Cuomo and the leadership of the Senate and the Assembly continue to focus not only on that investment short-term budget issue, but the long-term issue about how do we do business more effectively. The reason it's important for me to mention this is because much of the actions that this group takes and that your new CEO and Chairman Joe Lhota bring to the table is really very focused on that. But I will say that we were very glad to be able to share with you the good news in the 2012-2013 budget. And to just run through a few of those highlights, with Governor Cuomo's leadership and the leaders, as we committed, and trust is a big underlying theme here, we said, trust us, you will be made whole on the mobility tax modification. And as you saw, there was a general fund transfer of approximately $250 million, which represents 3/4 of the year because it doesn't kick in until April, to help supplement the mobility tax trust fund. Bob Ferran will tell you the most important part is it not only shows up in this year's appropriation, but shows up in the long term in our financial plan, so it can be counted against your future budget and financial planning. In addition, the state financial plan continues this for another 4 years on top of this one, and you'll see a growth in that pattern as well. We will also carefully monitor and check that. We know that's important to you. The MTA also receives over $4 billion of the $4.4 billion that is collected statewide for transportation operations. And that's very important. It again points to the importance of this family of services and the importance to the region, but also the importance to the regional economies elsewhere. You've done an excellent job at pointing out how much manufacturing is done outside of the New York metropolitan area, and that has a real benefit to the rest of the state as well as to the 8.5 million riders of the service every day. This budget does something unique. In the past, you've watched the budget have to tap some of the MTA regional tax revenues to help the upstate account. This year, we did not do that. The full additional funding of $190 million stayed in the MTA account. We did, however, do a restructuring of what is called the transmission tax or the long lines tax. It is the only statewide collected tax, and we made a modification there. Instead of tapping from dedicated regional funds, we split that with 33% based on population going upstate and 67% staying downstate. It's a structural way to fix it that is more appropriate to the revenue sources than the old scooping out of funds that were collected at a regional level. So it goes back to our commitment to work with the regional taxes and help you secure those taxes, as you heard in earlier legislation. Probably the other very positive surprise for all of you, and hopefully good news, was that we also added $770 million to our capital program to help you fill the gap in the last 3 years of your 5-year plan. We know that this add was critical in addition to your efficiencies that you've identified to secure additional federal aid and close that gap and indeed make the MTA whole for the balance of the 3 years. Again, it keeps the same funding, that $25 million for school fares. It did add a new provision for state to pay the MTA for Easy Pass tolls for those residents that use the Memorial Bridge, the Cross Bay Veterans Memorial Bridge. That mechanism is being worked out, so before you ask me how that exactly is going to happen, we will work out those details, again working closely with the financial people here at the MTA. The last thing I want to mention before the numbers, and you'll get much more detail I'm sure from your staff on the numbers, is that the governor's budget does call for reform, and one of the things he's challenged me to do as deputy secretary and challenged all the other deputy secretaries is to bring families of services together. So we literally are now having weekly and monthly calls and meetings between New York State DOT, the Thruway Authority, the Bridge Authority, Port Authority in New York and New Jersey, the MTA, and Department of Motor Vehicle, because it's a family of transportation services, and we shouldn't any of us be acting solely within those boundaries. To that end, I want to strongly support Joe Loda's approach to really looking across all the agencies that make up the MTA family, looking for opportunities for reform and efficiencies across those different agencies. I know a lot of that's already begun. We're going to look to hear and see more of that from you, because at the end of the day, it's what our taxpayers expect, and it's the right thing to do. So again, I thank you very much for giving me a few moments at the front of your meeting, and I bring the best wishes for this year as we all together help advance this very important agenda. Thank you.
Karen, if I might say, and I'm sure I'm speaking on behalf of the committee, this is really great to have somebody from the governor's office come down here, and I think it shows that hopefully we're going to go forward with this working relationship that you talk about. Obviously, it's really important to the MTA. From our standpoint, this Finance Committee has been dedicated to be making sure that every buck counts here. Every dollar of revenue, state aid that we have, goes to the riders in the most efficient manner that is possible, and I assure you we will continue to do it. I welcome you to come back anytime. The door is open, and I think this was really a really good thing that you came down here.
Well, and thank you for your hospitality. I look forward to working with all of you.
Thanks, Karen. Okay, approval of the minutes. May I please have a motion of our December 19th meeting, Finance Committee meeting?
Motion made.
Second, please. All in favor? Okay, the minutes are approved. Doug, the work plan?
Yeah, there are no changes to the work plan that we presented last month.
Okay, and then why don't you go right into Budget Watch?
Yeah, we have a very brief budget watch. Typically in January we focus on the revenue side more so than the expense side because the data is very preliminary. It's not really that meaningful. So next month we'll be able to present much more useful expense numbers. So what I can talk about is what we've seen on the revenue side, and overall we're very, very close to the final estimate. The passenger and toll revenues were both 0.2% favorable, which combined for a $13 million favorable variance. PMT, MTA aid trust accounts, MTOA, and PBT receipts were virtually on target with the forecast. Real estate taxes were about $8 million, or 1.4%. unfavorable. That was the month of December was a little low. So if you net the $8 million unfavorable on the real estate against the favorable passenger and toll, $13 million, you're talking $4 or $5 million favorable, which is a minuscule variance actually. So basically you could say we're virtually on target on a revenue basis. Like I said, next month we'll have more information on expenses. We'll have a clearer picture of where the year ended. Yeah.
I think we'll just go right into Finance Watch. Pat?
Thank you, Mr. Chairman. Finance Watch begins on Roman numeral 4-1 of your committee book. We have a few things to report on. We executed a $58 million hedge for ultra-low sulfur diesel fuel on December 22nd, and this was, again, competitively bid among our existing approved commodity counterparties, Bank of America Merrill Lynch, Deutsche Bank, and Goldman Sachs. The winning bid was submitted by B of A Merrill for an all-in price of $2.889 per gallon. And the hedge provides price certainty for about 1.1 million gallons each month for a period of 18 months. Again, this is consistent with our discussion about fuel hedging to go out approximately 18 months. Total notional quantity that the agreement covers is just over 20 million gallons of the commodity, and this is compared to our budgeted amount of 2.994 per gallon for 2012. It locks in a price that is about 1.4 million lower. So unless there's any questions, I'll go on to the upcoming transactions that we're working on. We've talked about issues with our European banks in the variable rate portfolio, and with respect to the TBTA bonds, the 03Bs, the 05As, and the 05Bs, those are all bonds that are currently backed with by Dexia Bank. We've gone out and solicited bank capacity for these credits, for these bonds, and the low cost provider came in with was U.S. Bank. They came in with CalPERS and CalSTRS, interestingly. And so these bonds we're preparing a full remarketing of the bonds under the new credit arrangement with U.S. Bank, CalPERS, and CalSTRS. This entire transaction is scheduled to close on January 31st. We're looking forward to improvement in overall rate experience under the new arrangement of around 0.5%. Just due to the better trading value of the new banks that we're bringing in. Turning the page, we are also working on replacing Dexia. Sorry, Jim, go ahead.
CalPERS and CalSTRS.
Yes.
These are bank subsidiaries of the pension funds.
These are the pension funds themselves. That they typically they're active in this business, and they typically come into transactions partnered with another bank. U.S. Bank is one of those banks that they partner with, and it is the fund itself that's providing liquidity.
It strikes me that that these entities and others like them do provide a much more stable and desirable backstop than banks these days, and I'm happy to see that we were able to access their credit, assuming that we're not going down the AIG route.
Thank you. Yeah, no, I think that we were pleased to see them come in. There's clearly some interest on the part of the buy side to have exposure to them, and that's obviously a good thing in the way the paper trades, and it's it's a good thing for the fund itself because it's fee income that they need.
Just one other thing on that item: are their guarantee activities comprehended by the state regulation, the insurance department regulation in those states where they operate?
In California?
Yes.
Yes. Yeah, and we've received part of our closing process on the transaction involves certain certificates that the providers will provide, demonstrating their adherence to regulations of the fund itself and local law where they are domiciled.
Yeah, what I'm getting at is that as long as it's viewed as a mainline business by those regulators, we can, I think, have a higher degree of confidence that regulation is putting a deal of conservatism in their operations, that it's not going to be some rogue operation outside the four corners of their mainline business.
Okay. Sorry. Oh, sorry. Al.
What's the impact to the institution of the fiscal impact anticipated over the year?
To Triborough?
Yeah.
Yeah, we're expecting an immediate improvement in the way the paper trades, and you know, we're thinking approximately 50 basis points improvement over where the bonds are trading now. If you look at the book here, you know, the recent resets on these bonds have been about 1.3%, 1.25%, and we would expect under the new arrangement for the bonds to be trading much closer to, you know, slight spread off SIFMA. SIFMA right now is at 8 basis points. So, you know, if a spread of, you know, probably 10 to 15 basis points off that is more likely what we would look for. Again, you know, once it gets seasoned in the market, once the buyers, you know, get the bonds in house, then it, you know, there's a settling down of prices.
Thank you.
So as, I was getting into the on page 4-2, a similar transaction on the DTF 2002 B bonds, where we've got Dexia as the existing liquidity provider. We are working on a plan of finance that will bring in State Street Bank for a portion of that amount. There's a total of 440 million bonds outstanding, and we're looking at issuing the remaining 290 million of bonds as floating rate notes, or FRNs, and staggered maturities. We haven't worked out the full plan of finance around that yet, but we will be working with our existing remarketing agent on that, which is Morgan Stanley. And again, the expectation here is to improve the experience that we're seeing in the trading of the paper, to lower the cost by getting this bank out that the buyers have shown a reluctance to hold in their portfolios. And again, bringing in a high-quality name like State Street Bank is expected to improve the transaction. And we issued floating rate notes last year. We were very pleased with that experience. There's no bank risk. There's no risk of an entity getting downgraded and so forth. And so we think that that is going to continue to be a bigger part of our program going forward. As we saw last year, an unprecedented level of rating downgrades by banks that many of whom we work with has impacted the portfolio. So we think the floating rate note is an attractive option that we'll continue to look at. Okay. Sure.
Next is MTA headquarter and all agency items. Pat, we want to talk about it?
So turning to, in the committee book, to Roman numeral 5-1, we have before the committee for consideration a staff summary approving supplemental resolutions authorizing refunding bonds. And behind that staff summary that describes what we're seeking authorization for is the board-adopted refunding policy that was approved by the board on May 26, 2010. What the staff summary does is it authorizes refunding of existing fixed-rate bonds that meet the criteria as outlined on Roman numeral 5-4. There's no changes proposed to that policy. And then behind that you see a supplemental resolution for each of the credits that we borrow under, beginning with the transportation revenue credit, the dedicated tax fund credit, and both Triborough senior and subordinate.
First, a motion, please, to move the action item, and then we can talk about it. Okay, and a second, please. Okay, John.
Mr. Chairman, thank you, Pat. I have just a couple of quick questions or comments. I agree with the goal of what you're trying to accomplish, because when the market strikes, and when you're doing refundings, you can't wait a few weeks, which it might be under if you wait for the board to act. You got to be able to have a system in place to take advantage of market activity, which would improve the interest rates for us. So it's important to do that. I just want to confirm that there's in place a proper accountability at the board level, and that the board's kept current on any relevant information, and that any policies allow for the fulfillment of our duties as board members under securities laws. So we've gone over it. I just want to confirm that that's still done. But clearly you need flexibility to continue as you suggest. And then the other thing, so if you could confirm that, the second question is just to confirm that you've thought through any alternative ways to proceed, because there are probably a number of different ways to proceed, and that you're most comfortable, as long as you thought through alternatives and you're most comfortable with this way to proceed, it sounds like a rational basis on which to proceed. So that would be the second part. The first part is to confirm that these allow us to fulfill our duties. The second part is to confirm you've thought through other alternative ways. And the third question I have, all related to this, was I have a slight tweaking of the language. So if I could perhaps read the slight tweaking and then ask that you address quickly the two questions. I think that the way you have it worded, you have the chairman and chief executive officer, then you have the vice chairman. I think what you mean by that is the vice chairman, if serving as chairman in the absence of the chairman, but that if that's so, then what you did is you left out the chairman of the finance committee. So I think if you tweak that, I think that's what you meant. And then if not, I think that's what you should mean, so that the chairman of the finance committee is there, but you don't want to, if at some point the vice chairman is different from the chairman of the finance committee, you don't want to have too many people you have to go get. But then the language there, the conjunctive you use is an and. Again, it's the second paragraph under the purpose, if that helps. So I just want to confirm that it would be, it's the chairman and chief executive officer, the vice chairman if serving as the chairman, the chairman of the finance committee, the chief financial officer, and the director of finance. I want to confirm that you want all those people, and that you feel that that would not be, if that is correct, that that is not too cumbersome, and that is what you in fact intended and want. So that's the three things, please, and that's it.
I would just say that wouldn't be cumbersome. That would not be cumbersome to have all of those parties involved, because frankly we would want to keep the board informed, and so we would be keeping the CEO, the vice chairman, and the chair of the finance committee, and then Pat and I are working together, so we can easily do that.
And then the other two, just quickly, you've...
Sure, sir. John, on your first question about duties of the board in performing their obligations and their fiduciary role with respect to the issuance of bonds, these resolutions are consistent with past practice, where the board is essentially delegating to the professional staff in-house to take those actions, provided they fall within the parameters outlined by the board at the time it's approving the resolution. So here, everything keys to that refunding policy, and to the extent that the transactions are contemplated that meet that the criteria in the refunding policy, I believe that the board is indeed meeting its obligations. Okay, and the second question was alternatives. Really, the only viable alternative to what we're proposing today is to come back to the board each and every time there's a potential refunding. And as you noted in your opening remarks, that can certainly involve some amount of time, and we believe that is a less viable alternative than having the authorization up front, because we can miss those market opportunities that might appear. And
So, and we'll...
So, right, I would just remind you, when the board approved this refunding criteria, it was really modeled after the state's refunding criteria that it uses for refundings of its own bonds.
So if you see any need for refinements, in the criteria, you'll come to us, right? Because I think we all agree, if you miss great refunding opportunities by relatively insignificant amounts, you should have the flexibility to come back to us. So that doesn't change, correct? And you're still going to apprise us of developments
Exactly.
in the same manner that you've done, right?
Right. The Finance Watch is really the vehicle for the board, the Finance Committee members, to be apprised of what's happening in the Finance Department. Anything that is going on from a transactional perspective, we're obliged to report on, both, looking back and looking forward, and that's the way, today's Financial Watch went. I described the transaction that we settled on, as well as the two that are ongoing.
Thank you. If you can make that tweak in the language, it sounds like I'm very supportive of it. Thank you.
Mr.
Assuming that this procedure is utilized when there's an opportunity to refinance, will there be an explicit understanding that you come back to the board and explain what happened, aside from memo and Budget Watch? The fact is, every time that there's an issuance, Freddie, they come back and report at subsequent board finance committee meetings as to what happened. They do this. You do this a regular practice.
Yeah. I was just looking here for the to response to your using the word formal. The full board receives a electronic copy of the preliminary official statement anytime we get into the market, and that's your opportunity to see the full transaction laid out. And then, of course, as I said, Finance Watch is required. It's part of the work plan, and I'm required to come in and report on what's happening, what has happened, any issues in the portfolio. So I think that it does exist.
Wait, just so I understand it, and forgive me, you go through this process to take advantage of an opportunity in the market. At some time subsequent, you come back to the board or the finance committee and explain it, right?
Correct.
Oh, thank you. That's what I was asking.
Okay.
Are we going to have a presentation of the year-end reporters?
Yes.
Thank you.
Okay, so we have a motion, and we have a second, a vote. All in favor, please? Opposed?
Okay.
Next.
Thank you. Sure. Okay. Sorry. The next item before the committee appears on Roman numeral 5-60 of the book, and this is authorization to issue transportation revenue bonds, Series 2012A. This issue is being contemplated. It's contemplated to approve new money proceeds for existing approved transit and commuter projects in the, again, existing approved capital programs, primarily the 5 to 9 and the first 2 years of the current program. The resolution, again, describes the possibility of doing this in multiple series, but it's and the specific plan of finance will be described next month as we get closer to being able to issue the bonds.
Second, please. John, do you want to speak?
No, I just want to note an abstention in my vote, please.
Okay, so Doug, would you please take that down? Okay, so we have a second. All in favor, please? Opposed? So moved. Okay, action item number 3. Pat?
Sure. So turning to Roman numeral 5-73 of the committee book is a staff summary describing a transaction that we would like to undertake with respect to $210 million of outstanding transportation revenue auction rate bonds. As you know, this is a product that is not working well in the market, but because of the overall low rate environment, it has not been a major hot topic for us. However, we saw a good experience with tendering of the 2 Broadway cops just recently at the fourth quarter of last year. We would like to propose a public tender of these bonds, and we believe that we can refund them at a substantial discount, with savings. Happy to take questions about this. This would just, again, enable us to bring the bonds in, hopefully at a lower than par cost, and refund them out in what is currently a historic low rate environment that we're in. And happy to take questions.
A second, please. Second.
Pat,
Mitch, yep.
could you just amplify the first paragraph on 5-74? I think I know what it means, but could you just...
Sure. Yeah, it might be good to just look quickly at Finance Watch so we can see what the actual numbers look like. If you go in your book to page Roman numeral 4-8, here's where we see the actual interest rates that we're paying on these auction rate bonds. And I direct your attention to the first block on where the issue is described as TRB 2002B-1, and you see that's $105 million, and you see that we have J.P. Morgan and Merrill Lynch as our broker dealers on that, and then you see those rate resets, 0.51%, 0.54%, and so forth. And then if you look down, just follow that same row all the way down to the lower block, you see those rates that we're seeing on a similar $105 million. That gets us to the $210 million, 0.31%. So to get to your question, I guess you want to get to the failing aspect of it.
Right.
The auction rate market it was built upon the presumption of investors providing liquidity to each other. There's no intermediary like a bank that would stand in and take the bonds if an investor wanted to get rid of their position. Back in 2008, when all the monoline insurers were downgraded and started to exit out of the market, investors quickly realized that there is no intermediary here. The insurers are just there to cover principal and interest in the event of a default. And so since that time, auctions have been failing. When they fail, the bond documents underlying the auctions speak to what the fail rate is. And in the case of these bonds, they're failing at 1% of LIBOR, and that's all described on the page here. As you can see, the corresponding fail rate of these auctions is 200% of 1 month LIBOR. 1 month LIBOR right now is 27 basis points. So as you can see, that it doesn't cost us a lot in this low rate environment. The concern is if we wait and we get into a high rate environment, we say, geez, now LIBOR is, call it whatever you want to call it, and we're paying 200% of that at that time. We say, okay, let's pull the trigger, let's refund now. Well, then you're refunding into a higher rate environment. So we've kind of been riding this for some time and enjoying these low rates.
Right.
We sense that investors want out of the product. They want liquidity. They want their money back, and we think that enables us to come to a transaction that satisfies their needs to get out and satisfies our needs to deliver some savings, and we're doing it in a way that allows us to issue a refunding bond in a very low rate environment, and that's kind of the whole.
And I assume it's that last piece that is so enticing, because if we were not able to do it at a low-rate environment, the spread would be greater, and therefore would not be in our best interest to do it now, unless I missed something.
Well,
the low-rate environment for that fixed-rate refunding bond, what do you expect to pay for the fixed-rate refunding bond?
I guess the best example is what we did on the transaction with the 2 Broadway cops, where we used the transportation revenue credit. I think we were inside of 4% on that. That transaction was a 3.99% all-in TIC.
So that's 4%, and we're currently paying about 0.5%.
That's right.
I do believe that we can have greater variable rate exposure, and we will add to our variable rate exposure. I just don't think we want to have this product be in our variable rate exposure. So we recognize the difference between the fixed rate versus the short term, and we will be adding more short term product there. But again, this broken product, we just feel like let's get out of it and then take our variable rate short term exposure with something else.
Do you actually have to pay 100% of face value, which is apparently what you're talking about here?
No, we believe we'll be able to.
That's the ceiling. We're quite frankly, on the 2 Broadway comps, the tenders came in at 97 cents on the dollar. So we would expect something even better here. Again,
you're among the last to bail out on these auction rates. J.P. Morgan and a few others got sued on them. So you're among the last to bail out.
We've been going out on a steady basis. This is not the first.
No, it's a good thing to get out.
We've been eliminating.
We've been eliminating this over the last 3-4 years, right?
Well, beginning in 2008 when the market started to.
Slowly but surely, we've been eliminating the product, which I think is the right way to have done it.
Okay.
Have you or your advisors come up with a pricing rationale on this? 97 doesn't sound like a tremendous discount for bonds that are yielding less than yielding 0.5% and have an almost an infinite liability or infinite duration.
Well, again, we don't set that. The only thing we do is we draw the line on those proposals that are submitted by the investors. They can submit, at any price. And in fact, what we saw on the 2 Broadway comps was that some investors did just that. They said, "I want out of this bond at any price." It was a small universe that did. And then we had some that wanted out at a higher price than where we drew the line, and so they continue to stay in that product as described on this page here, the 2 Broadway comps. We still have auctions outstanding there, so we wouldn't do this at a par. We would do this at a substantial discount to par.
But is 97 is something in your wheelhouse?
Well, it has to be only to the extent that's our only relevant experience. Quite frankly, it's just a number, but it's a number that does point to a transaction that was executed.
When you look at your all-in cost for the deal that you're doing with the pension fund backing,
yes,
what is it? If you manage to get down to a trading cost of 20 or 30 basis points, what are you actually paying?
About 1% to 1/10 in that range.
So, notwithstanding the unfortunate aroma of this transaction as a variable rate pegged to a proportion of LIBOR, double, it's really extraordinarily economical for us at the moment.
Your point is taken. It is.
I guess that's the point, right?
I think it's aroma-free myself.
No, not really. I just, whatever.
I guess it's all described here on this page. It's the remaining comps. It's about dollars all in. We're 315 million or so of auctions. Our portfolio going into the market dislocation in 2008 was over $2.5 billion. So we've done a lot.
Yeah.
Mark, your point is taken, and I know that many issuers have continued to try to ride this out as long as they can. One of the things that prompted us to want to put this on the table now is, and we'll talk about this more when I discuss the financing plans for 2012, is we've got a lot to do this year, both in terms of banks that are exiting the business where we need to find replacements, our traditional new money deals that are going to be about $2.2 billion, and then there's an enormous amount of refunding bonds that, if the market conditions hold, would compel us to be active in the market that way. So the thought was, we're going to be pretty occupied with other stuff in the year. Let's get this out of the way now. We think we've got some motivated investors to put a very compelling offer on the table that will allow us to refund the bonds. Again, I would go back to the 2 Broadway comps deal. The 97 cents, even though all in, the present value savings, again, depending on what you assume LIBOR does in the future, we're about $73 million in savings on that. And that assumed that LIBOR starts to go back to its 20-year average over time. And we were just using the forward LIBOR curves, the same curves that are, trading in the market now, that people are trading on in the market.
That's theoretical.
It's theoretical. It's assumption driven. Absolutely.
Do you have? I don't mean to beat this to death because I understand the reasons why you want to do it, but I do want to get it on the table. Do you suspect that any of this paper has traded out of the original hands and is now lodged in speculative holders?
It may be. It's hard to tell. We do know that there's a concentration in the broker-dealers that are on the transaction. B of A, Merrill, and J.P. Morgan probably hold at least half of this paper.
Yeah. Well, that being said, I personally would be, and I know you would do this as well, but just say it anyhow. I'd be pretty tough. We're not dealing with mom and pa here, and we're going to beat the hell out of them.
Well, I think I think we will. Look, the papers are designed to allow the investor an opportunity to value their position, to take a stock of what works for them and what doesn't work for them, and they put a number on the paper. If we like it, we can accept it. If we don't like it, we don't have to do the deal. And
I share this sentiment of not beating the subject to death, but just sort of one more thought. If you had any way of determining the current trading value of this stuff, and it may not be trading a lot, but I bet it is trading to some degree, you might get a sense of what kind of windfall you are going to drop on the holders of this stuff.
Mark,
fair point.
If I could just set everybody at rest, I just had a little talk with Bob. I think that the fellas, in order to do this, are pretty confident that we're going to come out just fine. So I think we should leave it like that. They're not going to do it unless they feel very comfortable that the MTA is getting a good deal.
But your point about trading activity is taken. A member of our financial advisor team is here, and I will ask them to go and prepare some analysis on any secondary market trades that can advise us as we can, move the transaction along.
I think we've talked us to death, really. We have a motion. We had a motion. Did we have a second? Yeah. Okay. Thank you, Counsel. Okay. And all in favor?
I'd like to abstain on this.
Please note that
Thank you.
John Ballin is abstaining. Okay, so all in favor? Aye. Opposed? Thank you. Okay, there you go.
Okay.
You want to go with your...
Sure.
Next, we have MTA headquarter report and information items. We have 2 items, and the first is the...
Oh, okay. Just before we get off the subject of debt and retiring debt and on debt, okay. 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 I'll get back into it then.
So I totally missed something, and I'm not going to ask the committee's indulgence right now, but maybe staff can follow up, but I might have missed that under Budget Watch. I know the governor's office sent someone down to explain how happy we should be about the governor's budget. I don't know if we got an analysis from the MTA staff of whether we should be happy or not. So I'd like to ask that they can send that to us rather than take time at today's committee.
Yeah, sure, we'll do that.
Thank you.
So we have 2 information items, and Pat is going to take us through the finance report, 2011 year-end report.
Here is what we were waiting for.
Okay.
This is the big presentation.
Okay. Put it up on the screen. Okay. So, sure. I think this report is an information item for a finance committee that is a January work plan requirement, and I will present a summary of the debt portfolio financings that we undertook in 2011 and describe our finance plans for the year ahead. Here you see our portfolio of outstanding debt, now just at over $30 billion, which is predominantly in the fixed rate mode. You see $24.1 $1.34 billion, or about 80%. Synthetic fixed rate, unhedged variable rate, commercial paper, and mandatory tender. Those are the key categories that we issue our debt in. In 2011, MTA paid about $1.933 billion in debt service costs, which was about $53 million lower than forecasted in the mid-year plan, the July plan.
Because of the auction rate bonds?
In part. Savings were due to low interest rate environment overall, which benefited our entire variable rate portfolio, and as well as the timing of bond issues. And but I would note that the debt service paid in 2011 did include $588 million in principal through just our normal amortization. Here you see debt, how it's dispersed across our various resolutions, with the bulk of it being the transportation revenue bonds of over $16 billion, dedicated tax fund bonds, which are $5.3 billion, Triborough Senior and Triborough Subordinate, and that thin little sliver at the top as the remaining certificates of participation for 2 Broadway. I would just remind everybody of our outstanding credit ratings. Transportation revenue bonds are rated A2 by Moody's and A by S&P, as well as A by Fitch. Dedicated tax fund bonds are not rated by Moody's. They're rated AA by S&P and AA minus by Fitch. Triborough Senior or AA2 by Moody's, AA minus by S&P, and AA minus by Fitch. Triborough Subordinate are just one notch below that. Turning to the market recap, we asked our financial advisor, Lamont Advisory, to prepare a market recap to briefly describe the conditions that we issued in 2011. Most notable was that the year continued a period of very low interest rates, which is continuing into 2012. I would also just reiterate again that in 2011 was notable that rating actions on banks globally were significant. It impacted many banks that provide letters of credit and standby bond purchase agreements to the MTA, so it was a significant factor. Turning to page 4, you see here the columns represent our the all-in TIC of our fixed-rate transactions. The squiggly line at the top is the bond buyer revenue bond index, which averaged 5.31% through the year. That index consists of 25 various revenue bonds that mature in 30 years, and the average rating is roughly equivalent to a Moody's A1 or an S&P A+. A fairly comparable index by which we would look at, particularly for the transportation revenue credit. Turning to our 2011 transaction summary, we issued $1.2 billion in new money for existing approved capital projects. I would just note that we did, you may recall at the end of 2010, we did a large transaction to take advantage of the end of the Build America Bonds program, so that money was used in 2012, in 2011, and that resulted in about a $2 billion new money need use in the year. It included a large amount of fixed rate bonds, as well as we did get a tranche of variable rate bonds out there, $100 million through a liquidity facility with the Bank of America. We did continue to issue in our commercial paper program. The low rate environment allowed us to undertake $2.1 billion in refundings and remarketings. The refundings themselves were $935 million, the biggest of those being the TBTA deal, where we provided savings of approximately $87 million on a present value basis. Early in the year, we did the DTF 2011As of about $10.5 million present value savings, and then the 2 Broadway COPs, again, on an assumed basis, generated about $73 million. $1.2 billion was done through remarketings of tendered obligations with new bank facilities. $448 million of those were done as weekly VRDBs. We did a $200 million private placement with Wells Fargo, and then $134 million of floating rate notes, or FRNs, and that was done through the dedicated tax fund credit. Again, that $588 million was retired through normal amortization. Variable rate portfolio management continues to be a major focus, and variable or synthetic variable rate issued with liquidity or credit enhancement has decreased over 25% since 2008. In spite of that, we've been working very hard to maintain what we've got. This speaks to the challenge of maintaining a meaningful amount of debt in variable rate mode. As we talked about earlier, the good news is that we are seeing banks interested in working with the MTA, as well as those pension funds from California. Even with a slightly higher cost environment for bank liquidity, variable rate debt continues to be a very low cost alternative for the MTA, and something we're going to continue to work on. Here we look to the year ahead and what looks to be a very active year in financing. This page is a forecast of the financing calendar for the year ahead on a quarterly schedule. Everything here, of course, is preliminary and subject to change, but I would just note that new money issuance is roughly what we would expect is about $2.2 billion for approved capital programs only. If the pending amendment is approved by CPRB, it would only increase this slightly, maybe about $100 million, depending on the way cash flow works. That borrowing would really start to be noticeable in 2013.
There still would be probably $400 million of RIF. If we do have the RIF loan approved, we would borrow about $400 million through RIF, but only borrow about $100 million
through bonds. Yeah. So, thank you. The line on remarketing is only for those existing variable rate bond deals with LOC or SBPA bank providers expected to not renew. So these remarketings are contemplated here in our plan. What's notable here is new proceeds are not generated. This is just maintenance of the portfolio itself. And I would note that mandatory tender bonds with tender dates this year are in this category. Refundings are noted as we are now 10 years past the debt restructuring. We will evaluate opportunities to refund the debt to capture debt service savings. And I'll go through each of these categories in more detail. Here you see new money borrowing for 2012 out through 2015. And what we show in the dark green is what's already approved by the board and the Capital Program Review Board. And the immediate next section up takes a look at 2012 to 2014 bonding. And then on top of that is what we would expect to incur through the RIF loan that Bob mentioned. And more detail on the remarketing here on page 9. What you see are all those facilities where we've got bank agreements that are expiring in this year. And this is a very common occurrence. Bank facilities are usually 1, 2, or 3 years. It used to be they would go 5 years or sometimes 7 years. We don't see that anymore. So there's just more attention needed to keep the transaction in the market. And you see those lines in green are what I discussed earlier. Those are those Dexia facilities where we're actively working on transactions, I should say, to replace them with stronger names. And then at the bottom here, just this little section on those mandatory tender bonds that will need to be remarketed this year. So here's a presentation of our refunding outlook for 2012. We see approximately $6.7 billion in bonds that are non-advance refundable that will become currently callable 90 days prior to their call date. And you can see the bulk of the bonds here have a call date of November 15th. Those are all the transportation revenue, dedicated tax, and Triborough bonds. And then there's the first line there, state service contract bonds. We see that 1.3 million will be currently callable on July 1st. Again, it will be currently callable 90 days in advance of that. Also, approximately $484 million that we see right now of advance refundable bonds could be refunded for savings. I would just note that in the current market, there's negative arbitrage. that eats into those savings, and that's why we're not moving quickly on those right now. We think that waiting till the bonds become currently callable has benefited us, and I would just note on that Triborough transaction that we undertook last year, we were seeing proposals from our senior managers to refund those bonds in advance while they were advance refundable, and the negative arbitrage was a significant issue there. We decided to wait. I think waiting was the right thing. In that case, again, the present value savings were dramatic, over $86 million on a present value basis. And so while we're continuing to watch these bonds, we're not eager to get in and leave money on the table in the form of negative arbitrage. We'll move on here. Your package has a rather detailed appendix of a number of documents, just a kind of a very top-line summary of some of the major investments that were made with the new money proceeds in 2011. I'll just leave that as a takeaway. Next here, these are all the transactions that were touched in 2011 in one way or another, either as a new money borrowing or as a remarketing. Everything is laid out here, including the underwriters that worked on the transaction, the purpose, how the assignment of the underwriter was made, whether it was merit or rotation or an existing assignment, the all-in cost, and the average life. Everything's described there. Here is what it cost us to do all that work in 2011. This is our cost of issuance summary, and every transaction is listed in a column, and then those items that are customary in terms of what we would incur. The first item there on the sheet is the New York State bond issuance fee, just under $16 million, underwriter's discount, bond counsel, and so forth. And you see that by transaction. And then lastly, we have 2 pages of all those variable rate transactions in our portfolio. This is our sort of our score sheet, if you will, our worksheet that tells us when we've got to prepare to get into the market and remarket bonds. And this goes out to 2015. We put mandatory tender bonds on this sheet. We put floating rate note bonds with maturity dates on here so that we're prepared in advance. We're not caught off guard by bonds that are coming up and need to be remarketed. As you can see, we've got some transportation revenue bonds with facilities that are expiring this year. We're already working with our FA to go out with a solicitation, so we know what the appetite and cost for those facilities would be, those replacement facilities, and so that's an ongoing matter for us. Mark?
As I recall, the timing of your new money borrowing, it's sort of toward the front of the year.
Yes.
And your expectation of capital cash flow, and just this issue that you mentioned in terms of the negative arbitrage that
on the refundings
that hurts you on the refundings.
Yeah.
I mean, the same thing is true on forward new money borrowing.
That's a good point. We're paying attention to that. We're not going to execute the.
Page 7 has the whole thing by quarter.
Yeah.
I know.
We're measuring that and getting a sense of that, getting a better handle on the cash flow. So we're not going to get in too early, but clearly it's going to be, assuming rates hold where they are now, there's going to be a lot of issuance in the market, and to the extent that we can get some of that new money done now, it will I think be beneficial, but with that caution noted.
Thank you, Andrew. Following on to that, I know we don't want to get caught trying to call rates, but I think given where rates are, it's hard to imagine they're going to be much lower. The question is whether they'll stay where they are or they go up. And so it seems to me to the extent that we can economically trade out into products that are being priced in this environment, it would be to our benefit. I'm preaching to the choir. I understand that, but it is. I think it's. We have got a strong hand here with the quality of this credit. I noted. I got a couple of three things. That's all. Okay. That I noted a private placement that was done.
Yeah.
And I wanted to inquire as to whether you perceived that there were some real benefits that we could garner by doing privates that would both cut down on cost of issuance and also give us flexibility that would be important to us, as well as perhaps a rate advantage.
Sure. I mean, I would just note it was a private placement, but it was fully disclosed. We put those documents up on EMMA, the Electronic Municipal Market Access System, which is run by the MSRB. So, I mention that because it's a big issue in the market generally. That an issuer that does a private placement needs to disclose that, and there was no question on the part of this finance team. We disclosed it. It was
no wrong.
But it was a transaction that we think worked very well for us. Whether or not the bank gets downgraded or what have you, there's no impact on the deal. The bonds trade at a spread to LIBOR in this case, and we're reporting on that to the board how it's going, and so that would be absolutely one of the possibilities that we would look at on these slew of remarketings that we have to do. If there's appetite on the private side, and we can compare that to where banks would cost to provide a liquidity facility, or where it might cost to issue a publicly issued FRN. That we align those things up. We work with our FA to
if it's
analyze
private,
them.
they might not require a backup.
Right, but ultimately there's a cost, and what our goal is to pick the alternative with the lowest cost.
You're dealing with sophisticated investors, and they should be able to look past that, I would think.
Yeah.
And just one quick question on the excuse me, the cost of these refinancings.
Yes.
With near-end maturities or open periods, if you will. Right. I mean, it seemed high to me. That kind of number, $70–80 million. I mean, we should have sliding scales on those prepayment penalties, right? And it looks like it just.
You're talking about this sheet here, the cost of issuance summary.
Yeah, it's coming. It's not necessarily this. No.
No, I'm
for
sorry.
For futures, for what you're saying that it's going to cost. It's going to cost us $70–80 million if we call bonds early this year in order to take advantage of low rates.
No.
We have the bonds cannot be currently called until their call date, which is November 15th. And I think most of our bonds have par calls.
That's right.
Par calls. So we'll be able to call it par. The tax law allows us to sell bonds 90 days before that current call date, put the money aside in escrow. Again, we earn less than 1% on it. But so we have a 90-day window when we can go into the market to try to take advantage. The problem we have is we have so few bonds that can be advance refunded. And with the advance refunding, we have the right to sell bonds at any time, but we just have that long escrow period where it costs us. So what we're trying to do is on the advance refundable bonds is do that trade-off between what's the negative arbitrage we're getting versus what's the risk that rates could go up and we could lose it all. So that's what we're looking at. We are also looking at doing some other products, forward bonds, forward delivery bonds, where we reach an understanding with an underwriter or an underwriting group where we will sell them bonds for delayed delivery. It could be 6 months delivery. It could be 7 months delivery. We're going to pay a premium over the market rate for that, but at least we know we've locked in savings at a level. So those are the things that Pat and his staff will be looking at. Is there is a trade-off that rates could go up, and for that reason we may want to try to lock in some monies with possibly less efficient products today, but at least we've locked up savings. So that's exactly how we're going to try to approach this.
Thank you. Am I correct in comparing the 3.95 billion issuance in 2011, which is on top of page 14, with the 11 billion anticipated in 2012 on page 7? Are those the two numbers I'm correct in comparing?
Yes.
So that we right, that's, I just want to make sure. Okay, so we sold a little over 3 billion in 2011, and our plan is to sell a little over 11 billion in 2012. Okay, as long as I just want to make sure I was comparing the correct numbers.
Yes.
So therefore, the cost of issuing the 3 billion in 2011 was $32 million, which is right?
Yes.
Of which 15 million was paid to the state of New York.
Correct.
So everybody else got 17, give or take. Have you done an analysis of what the cost will be in 2012 to sell the 11 billion?
No, not detailed cost analysis. I will say that I would just note that any remarketing that's done here does not incur the state bond issuance charge.
I read that. Right, okay. That I saw.
So, well, look,
so you can't just take the 32 million and multiply by 4. That I understand.
No.
But there is some number above 32 that will be the 2012 cost of issuance. I assume.
Yes. Absolutely.
And the question is, some estimate of what that number would be.
That's a fair question, and I could certainly come back to the committee next month with
that would help.
Some analysis on that.
Okay, and the second question is, the prices that are paid, leave the state of New York out for the moment. Take the 15 million, leave it aside.
Okay.
The other 17 million,
yes,
the prices that we pay to the various entities to do all of this for us, how are those prices set?
Well, there's a variety, because you can see here there's a lot of different categories.
Yes.
Some categories, like the ones that occur on every transaction, the rating fees. Those are fees that are set by the rating agencies. It's based on how frequent you issue bonds, the size of the issue that you're coming to market with, and so forth. There's no ability to really negotiate with them. We from time to time we'll push back, but counsel fees. On bond counsel, they bill us based on a pre-agreed what's in our agreement on an hourly basis. So actual charges, they bill us in 6-minute increments, and that's the cost of
but
legal
those,
advice.
I assume, leaving the rating agency issue out, which
Yeah.
you said is a set price, which I may not agree with or may not like, but I
Yeah.
would agree. I understand the context. Everything else is a negotiation between us and somebody.
Well, right. With the exception, however, I would just note that with respect to bond counsel, with respect to our financial advisor, but we have contracts in place with those entities where we've negotiated hard to come to an agreement, and those agreements follow. Those costs follow the agreements.
That I understand.
So
right.
where we can negotiate, it's on the underwriter's discount.
Right.
What the underwriters make. We can certainly, our swap advisor fee. I would put that in. We have a negotiated contract with them, and I think that their fees are in line with that contract. Bond insurance. The only reason we have this here is that quite frankly, more often than actually bringing bond insurance into a deal, we have to pay to get bond insurance out of a deal, and that's a negotiation. We can try to push back there. Printing and distribution, that's contractually based.
Right.
Trustee, contractually based. The auditors, contractually based. So there's not a lot of negotiating room we have here, except for what we the interest rate and price and
Right.
what we compensate
Right.
the underwriters on.
I think it's worth noting that although you skip over the state of New York, the fact of the matter is the largest number for the most difficult to determine value is that particular time.
I'm not. I wasn't skipping over it because it was inconsequential. I was skipping over it because it was not our negotiation with them. It was their negotiation with us, or they're telling us here's right.
Yeah.
They're basically telling us here's the fee. okay?
Right.
That I understand, so that's why I was leaving that aspect out of it, not because I wanted to. We could all look at $15 million and have $16 million and have a much better use of $16 million, okay? Yeah, so, but that was my point, is if you could provide us with an analysis
Sure, we can
of the
certainly
cost
do that.
issuance at the next meeting, that would be very helpful, because obviously, these costs are there for a purpose, but the question is it the best use of our funds in today's marketplace?
John, I believe
Mark?
you want to say something, John, or not?
I was going to, I think a couple people did, I was just going to comment on the relatively large number that is the New York State bond issuance fee, which is really a little odd. I realize we just had a nice summary of how the budget's being helpful to us, but $16 million is coming directly back out of us, and that is about half of what was spent. So you've got large groups of people working very hard on the financings, all subject to negotiation and competitive processes, and getting about half of what it's costing us to issue the bonds. So I would put the emphasis not on the people who are working hard in accordance with their contracts, but on the state that is really taxing us, the $16 million.
Well, the only aspect the point
Or
I
the
made
$50
was
million.
Right. The $16 million or the $50 million or whatever it's going to come to is set by law.
Right, but if we don't pay that tax, how are we going to get our state aid?
No. I'm not indicating that we should not pay the tax. Okay, although I'm sure some people who pay the mobility tax thought about not paying the tax. But be that as it may, it's not a question of not paying the tax. The fact that the tax is there in the first place obviously directly affects our ability to use the money. But the point is, everything below that number is to some degree more controlled by MTA than the legislative enactment is. That was the only point I was trying to make.
Alan?
Yeah, I mean, Mitch and Jonathan have both touched on the point that I wanted to make before, which is that looking at this coming year, the debt that we have is going to cost us $50 million in taxes to the state of New York. And we have discussed in the past seeking legislative relief from Albany as a result of that, and I want to know if anything has been done towards that end and what the response from the legislature and the governor's office has been in giving us that relief, because $50 million is a lot of money that can help deal with deficits in this year as well as restorations and service.
I have asked both Joe and Joe, really, actually, I asked Joe to see what he could do to see if we can get a waiver, since we're going to be doing so much issuance this year because of the refunding. And I think that Bob and Joe are going to try, no promises obviously, but they're going to bring this matter up before the state and see what we can do because of the sizable amount of refunding what we're going to do this year. So hopefully that's going to be underway. Thank you.
Thank you.
But to get legislation, I think you just forget it. The best way is for Joe to talk to the proper parties at the state and see if we can get some kind of a deferral.
Well, there has to be legislative
It's not going to
relief.
happen that way. The state legislature passed a law enacting the fee. They're going to have to give us the waiver.
No, it's not so. The budget department can do this.
Well,
On its own?
Not saying they will, but it's
The
possible.
state budget director has the,
Right.
it's contemplated in the act that the state budget director can waive the fee.
Right.
I think the notion that a refunding bond is more similar to a remarketing than it is a new money issuance should
right.
carry the weight, because they
That's-
shouldn't have a disincentive for us to issue bonds to save the taxpayers'
That's
money,
why we're doing
which
it,
is
John.
all the refunding
John, based
is.
upon the $6 billion plus contemplated refunding, exactly right. That's why we are going to try and take this up.
And I think there would be policy and other reasons. I mean, I'm familiar with what Pat just referred to. I think there would be policy and other reasons to take our entity, which is financed, by state taxes, and make it an exception, particularly for refundings, if you want to start splitting differences. Thank you. Yep.
Okay. Thank you very much, Pat. Excellent report. Doug, you want to do the procurements?
We have one other information item. Sorry. Just that the financial statements for the 9-month period ended September 30th, 2011. They've already been distributed, and they'll be discussed at audit, I believe. Yes. Yeah, exactly. So next we have procurements. We have 3 procurements for headquarters for a grand total of $2,678,806.
Motion, please. Second, please. All in favor? So opposed? So moved.
Okay. Metro North Long Island Railroad Committee, there are no items. No items for MTA bus operations. No items for bridges and tunnels. There are 2 non-competitive procurements for New York City Transit for an estimated grand total of...
Look how much money we're saving. We have no expenses. You see, this is unbelievable.
For a grand total of $3,652,658.
Motion, please. Second, please. John?
I just had a question on the Nordco. If you could give me a short explanation of Nordco.
Sure.
It says specifically, if it helps, due to the existence of a single responsible source, and you give awarding a 4-year sole source, which raises questions as to whether you expected there to be one single responsible source, whether you expect any entries into the field over the next 4 years, and the like.
Is anyone from Transit here that would want to take that question?
Is Tom there? There's Steve. Isn't that Steve?
Ken Mooney from the Department of
Steve.
Subways.
Steve, could you...
That's a service contract for ultrasonic testing equipment on vehicles that we already have the equipment installed on. It's necessary for maintenance, calibration, and for the professional expertise to operate the equipment, which we found it impractical to retain staff with that expertise for ourselves.
Is that satisfied? Is that satisfactory?
Yeah, just one quick follow-up.
Okay.
I mean, it says that there's hourly labor rates and the discount rate. I mean, has there been negotiations so you're confident that the rates and fees are... Yeah. Oh, okay. If you have anything to add to the... Just... Sure. It's just... Started with a generic question. I was just surprised that there was only one single responsible source, not only now, but expected over the next 4 years for this. And that's what he was commenting on. So if you have anything to add to that. And then the follow-up question was the hourly labor rates and the discount rate for parts. How can we be assured that there was competitive pressures brought to bear on those numbers?
Steve, you got to speak a little louder. Maybe just stand up or go to the microphone.
We're leveraging a situation where we're taking advantage of equipment, our TGC 3 and 4 track geometry cars that already have Nordco equipment resident on them. We bought these cars a number of years ago. This contract in and of itself is to develop competition with Sperry, the company that's actually been providing ultrasonic rail testing for close on to 40-plus years. Sperry built the car, and we've been using them, and the car's reaching its useful life. So what we're trying to do here is leverage the opportunity of using the equipment, the Nordco equipment that's already in our TGC cars, 2 of them, and be able to get them to operate the cars as well as maintain just the Nordco portion of that equipment. That way we have 2 companies actually performing a very critical function, which is ultrasonic rail testing. Okay. With regard to the rates, we look at the rates, we compared them to what we would otherwise pay Sperry, and that's how we know that the rates are competitive.
All right.
Okay.
Thank you. Thank you.
We have a motion.
Andy, I just want to give you a heads up. There were 3 items this morning, sole source, in Metro North Long Island Railroad. I'm just as glad they're not here because I voted against all 3, but they have not come here.
Yeah, but that's nothing wrong with that because some things come here, some things don't, depending on the amount of the contract and so forth.
Okay.
Okay, so motion? Second? All in favor? Opposed? So moved.
There are no items for FIMTAX, so that would include the finance portion of the meeting.
Okay, so Jeff is going to report to us on the real estate,
Okay.
please.
Thanks, Andrew. I have 9 action items for your consideration, and as usual, summarized in staff summaries. These are, I think, without exception, straightforward in each of the cases where we're offering a concession, coffee concession and the like. We had competition and are offering to the high bidder. There's a couple of cases where we're sort of sorting out some easements, but I think, as I say, they're straightforward, and unless there are specific questions, I'd ask for your approval.
Okay, motion, please. Second. All in favor? Opposed?
Okay.
So moved, Jeff.
Okay, and then I guess if we can get the lights out, please.
Lights out.
Okay. Is this not working? Okay. Sorry. So this is the 4th of 4 presentations reporting on our efforts to identify opportunities to monetize the value of our real estate assets. In previous installments, I've talked about our New York City properties. Today, I'm going to focus on suburban properties. One point of clarification, our discussion excludes facilities in Connecticut. We don't control that real estate. As I noted when I made my New York City presentation, contrary to popular belief, we do not have a great deal of surplus property. To the extent the railroads once had development parcels in their portfolios, they've largely been disposed of already by our corporate predecessors, if not by us. To remind you, we are the successor in each case to private sector companies that were experiencing bad business, and as they went out of business, they tended to sell off their real estate. So it's not surprising, if you think about it, that we don't have a lot of surplus property. We tend to use our properties quite intensively for railroad operations, and obviously the efficiency of those operations remains our paramount concern. Nonetheless, we've redoubled our efforts to identify further disposition opportunities, both because it's the right thing to do and because the public wants to know that we're doing it. The opportunities fall into 3 categories: vacant parcels, adjoining right-of-way, station buildings, and parking lots. In the scheme of things, the opportunities we've identified here are relatively modest. There are no blockbusters like the sale of Madison Avenue buildings, but as Andrew said earlier, every dollar does count. Well, this is pretty blocky, this thing. Maybe I should just ask you to do it, Pedro. So, next slide, please. Right. So, virtually every month I come to the board with staff summaries for licenses, easements, or other readily terminable arrangements whereby occupants of adjoining land make ancillary use of bits and pieces of our right-of-way, whether for parking, utility, crossings, or otherwise. But for present purposes, when I talk about properties for disposition, I'm talking about parcels we don't need and that we can imagine someone other than the adjoining property owner taking an interest in. Go ahead, Pedro, please. And we've identified 5 Long Island Railroad properties in that category, and here they are. Next couple of slides, please. I'm going to skip over these quickly. They're in your materials. You can see they do. Go on back, please. They are, intact properties that someone may take an interest in for development, and we intend to offer them for sale shortly.
Where are the tracks?
Tracks are, I believe, just to the south there. Is that right, Pedro? A little hard to see on this screen.
Between the 2 parcels.
No, I'm sorry, just between. That's right, between the 2. They're on either side there, Jim. Okay, next. By all means. No, in each case, No, I can tell you that we started with a somewhat longer list, and we've winnowed it down with both railroads based on these sorts of considerations. Let's go to the next one, please. So in the category of buildings, we've concentrated on the station buildings. We've looked at all the other buildings. They are all being used except for our property in Mineola, which we're under contract to sell already for $12.5 million. Both railroads have a number of historic buildings that no longer serve their original purposes in whole or in part and are quite costly to maintain. In some cases, it's only feasible for us to grant short-term concessions for newsstands and the like, but in other cases, we've succeeded in transferring responsibility for the maintenance and operation of entire buildings by means of sales or more typically long-term leases, while continuing to provide amenities to our customers and preserving the historic structures. We've already disposed of 8 Metro North buildings in this way. We have an RFP out for 7 more Metro North buildings, and we're pre-marketing 11 Long Island Railroad buildings. Next slide, please. This is Hartsdale, which is a good example of one we've already done. This is a Starbucks, where Starbucks is the net lessee of the entire building. And next 2, please. These are the Long Island Railroad and Metro North stations that we've identified for at least in substantial part. These will continue to have waiting areas and bathrooms and so on in these facilities, but maintained by the lessee.
Jeff, so wherever you sell a station building, you keep the waiting room area, you keep certain amenities for customers?
Yeah, I mean, we sold Dover Plains because it wasn't needed even for that purpose. Generally speaking, as I say, our preference is to maintain the fee interest, do a net lease that whereby we retain control over those sorts of things. No, in all cases we do this subject to SHPO requirements, and that's in large part, frankly, the point of the exercise is to maintain control over the historic elements, but while offloading some of the costs. These are more about cost avoidance than sort of bottom line revenue. Depends on the particular case. Depends on what proposals we get and what we can negotiate for. You can, in the short answer is that we're always looking to offload all but the most substantial long-term capital replacement requirements. And in some instances, we're able to do all of it. In other cases, we might retain responsibility for a particular element, depending on the condition of the building and what the economics will bear. Okay. As I say, we do have an RFP that's been out for some while on the Metro North side, and we have a few propositions I think we'll be bringing you in the coming months. Let's keep going. So finally, I want to talk about parking lots. When I talked about our New York City properties, I noted that we have some properties that are being used, indeed intensively, for transportation purposes, but they may nonetheless have potential for what we referred to in that context as overbuilds. The analogous opportunities in the suburban context relate to our parking lots. Both railroads face significant parking shortages and can ill afford to sacrifice existing spaces. So if we're going to give up surface spots, we need to replace them with garages. Indeed, in some instances, our transportation mission may be best served by replacing surface parking lots with structured parking that we pay for ourselves through capital funds, utilizing substantially all the land we have available. Next slide, please. But in other cases, it may be feasible and desirable to convert surface lots to mixed use, such that payments from developers defray the cost of building new garages, and that's what I want to talk about a little bit today. This is just a kind of a conceptual illustration of how that, if you go back, Pedro, that previous lot, in theory, can support, next slide, a new commuter garage on the right and a residential and commercial development on the left. Well, it can be done either way. I think our objective conceptually is to achieve proceeds that are sufficient to cover the cost of a new garage. So you can do that through an outright sale, and where the developer in effect finances that land acquisition cost and pays you an amount that then gets directly expended in service of the garage, or you can finance off of ground lease payments. Whether there's a pilot there as opposed to full taxes is also a consideration. That's your question. No, well, I guess what I'm saying is that there's a case to be made for less than full taxes in some circumstances, depending on the demographics of the project and so on. But I'm not looking to get ahead of those kinds of discussions with local people. Generally speaking, for this model, we're talking about outright disposition. It's a lot cleaner. Right, but there's only so far you go with that. The point is that they're local services, and these projects need to, as I'll come to, these projects need to be done, consensually.
Does that include zoning and the air rights and what can be built there, Jeff?
Are you speaking of zoning power?
Yeah.
Well, yeah. Again, there's a legal case to be made that very strong legal case to be made that these properties would be subject to a zoning override and full tax exemption and the like. But I think that's not the way we view these sorts of projects. The way we view these sorts of projects is that we think we need to make them work for the local communities. We would not be looking to get out ahead of anybody in that respect, and we are looking to do projects that are perceived to be win-win. Well, again, I think we certainly have that power and reserve that power, but there's a well, again, I'm not disputing what you're saying, Chuck, but I'm saying that as a practical matter, I think in all cases we would be, we would be loath to act unilaterally and without any reference at all to local zoning considerations. We don't do that. We don't generally do that. ESDC doesn't generally do that. But having come to a local consensus, whether it's structured as a sale or a lease, you can depending on what the outcome is, you can get to the same place. I think it. Well, I know we've talked about that in the context of Madison Avenue, for instance. I think these are, I think these are cases to be examined on one at a time. And I understand conceptually the point you're making, but I also think that as so the way we got started on this is Mark was asking, I think, sort of how does the money flow, and the most straightforward way to do it is to have a lump sum payment made, or to have the developer take over the cost and responsibility for the garage.
Let's move on.
Okay.
I don't think this is the moment for the debate, but I would see this building as basically fungible. I mean, when we're talking office space in New York City, I mean, I don't think there's anything exquisitely unique about our ownership interest here. I wonder slightly in terms of, I know we have a major need for resources and sort of efficient use of our assets at the moment, but when calculating the long-term value of a transaction, there's the real estate custom is that the value of title 60, 80, 90 years from now is virtually nil. I think when you are responsible for an ongoing public service, that calculation is not necessarily that telling. I think that the fact of the matter is that the chances of our being out of the mass transit business 60 years from now are small, and the residual title has more value to us than would generally be calculated in the real estate business. And I just, particularly when you get into parking, I mean, I think our parking need at the moment is probably something that was unimaginable 40 years ago. And I don't know what our need is going to be 40 years from now.
Well, let me just be clear. I'm not talking about relinquishing control of the parking. I'm talking about relinquishing control of the residential or residential and commercial site. Maybe that's where we're having a disconnect. Okay. So next slide, please, Pedro. So we comprehensively surveyed our parking lots for the purpose of determining how many we think there are that are large enough and so configured and situated that they could conceivably support transit-oriented developments that would cover the cost of increasing the capacity of the lots in question by at least 15%. 15% is a fairly arbitrary threshold. That's not a lot of additional parking, but we wanted to set the bar relatively low for purposes of this analytical exercise. And we've analyzed each parcel with reference to both size and configuration and basic development economics. Next slide, please. So I'm happy to explain in more detail if there are questions, but the upshot of the analysis is shown in slides 16 and 19 through 19 in your materials, is that fewer than 20% of our lots are of a size and shape and so located that we think there's any point at all of thinking about them in these terms. And about half of those would work only if combined with adjacent municipally owned lots. So we can cycle through these. These are analyses first of the size. Go ahead. And then in turn the kind of density that would be required. That's a function self-evidently of land values. The higher the land value per residential unit a developer is willing to pay, the more money you have for substitute parking. If you figure, say, $40,000 a residential unit versus $30,000, say, as a pro forma cost per parking space in structured parking, gives you some sense of how we went about looking at this. Next slide, please. And finally, this gets you to the sort of basic inventory of opportunities that we think are worth our pursuing. Go ahead, please. So I want to stress this is an ongoing consideration for us. Questions of economic feasibility are really the beginning of the discussion. I appreciate the input on the subject of our sort of prerogatives vis-a-vis local control, but as I say, our sense of this is that we will do well to try to pursue opportunities where all concerned, including local governments, think that this is a good idea. We're talking about developments that have the potential to significantly improve the appearance of the areas around our stations, and we hope they'll be viewed in that light. Let me say that I have consciously and purposely not identified the specific communities that we're talking about here, precisely because I don't want to get out ahead of that process. I think that would be counterproductive. Next slide, please. But I do want to talk about one in particular because we're the furthest along on this. After several years of collective action and effort in both planning and in terms of addressing these sorts of fiscal considerations, in July of last year we issued an RFP jointly with the town and village of Harrison. We're currently evaluating responses that we received. You can go to the next slide, please. We're very enthusiastic about this project. We have high hopes for it. We think it's going to significantly increase the parking at Harrison for our commuters without capital cost to Metro North, and also create fill in a kind of a gap in downtown Harrison, which the locals feel good about as well. So we hope this will be a prototype for other projects of this kind to come.
Okay. Is that Jeff?
Yeah.
Okay. I think what's important here is, Jeff, now we're at the position with this whole project that we started together 2 years ago. Jeff has done a really good job. We're very advanced now on knowing what our space requirements are, what extra space we have, both suburban and here. This thing is underway. What's missing here now, and I spoke to Bob Foran about it, I spoke to Joe about it this morning, is we need management decisions now from the operating people, from the management of the MTA. Jeff's done basically what he can do. He needs decisions to be made now as, for example, where are the people from here going to go when we move out of here? How many people? Which different locations? Leases that we have, which ones are going to be terminated. So we're at the point now really where I think Jeff has got everything teed up. He's done a great job over the last, and you've done what I think we've asked you to do, Jeff. You really did. And now he really can't, he needs direction from senior management. And Bob, we talked about it before, and I think that we're going to follow up on this, but it's really up to management now of the highest level to decide what people and what happens here, because everything is really laid out. People know where we stand, and Jeff, I thank you. You've done a good job, and hopefully over the next couple months now we're going to get some really hard decisions made as to where we go with this whole real estate project. Is that fair, Jeff? Assumption?
Yeah, I mean, obviously we've covered a bunch of different topics here, Andrew, and I think you're referring to our first report on
I'm talking about the whole thing you've been working on.
I mean, in terms of our city property initiative, we have been working with the city. We are I think very close to issuing a bunch of RFPs through EDC for some of the properties that we identified. The office right sizing exercise was always understood to be a complex one. We've hired, as you know, a team led by Cushman & Wakefield with the Phillips Group, and we are pretty deep into a programming study to understand, who we've got, who needs to be next to whom, and how many vacant desks we have where, what it costs to achieve the kind of increased density at 2 Broadway that we talked about, and so on. But I think we're well into that and on track.
So what we want to do is get reports back, Jeff, over the ensuing months as you do the real estate report as to where we're going now.
I just wanted to add one thing on this. I want to thank Jeff for putting this together. The reality in most cases on Long Island is that the MTA parking lot is the largest piece of undeveloped property in the downtown. That's what tends it to be. Jeff and I have had this conversation on many occasions. So the ability to use the parking lot or lots, which MTA owns, as part of a redevelopment project is essential in many of the areas on Long Island, because it is the biggest piece of vacant land, and it tends to be near the train station, obviously, and that has become that development opportunity has become a cause célèbre on the island, and therefore the likelihood of development proposals coming forward, which will include MTA-owned parking lots, is going to increase, not decrease. We are well aware of a couple that are already ongoing. We don't have to mention those, but we know which ones they are. There will be others that are going to be forthcoming in the months and probably very close months ahead. And the ability and willingness of MTA to play a role in those developments is going to either allow the development to succeed or not succeed. And so this, I think, is a very good analysis of why it is so important that MTA has to be a partner with the local communities in those areas, because they are going to be a much more prominent role in development on the island in the months ahead. I know it already has occurred in Metro North. Metro North, the area is probably 5 years ahead of Long Island in the downtown railroad station redevelopment process, but we're always a little behind, but we're getting there.
Just on that score, I think that therefore there's a tremendous amount of pressure that is not necessarily consistent with the long-term prospect for mass transit on Long Island, which is at the moment in a lot of places drastically limited by the fact that the parking's not adequate.
No, but I think I agree with you. But that's part of the discussion. It is incumbent upon the development to add parking spaces to the numbers we have above and beyond our ability to do that. Because our willingness to build a parking garage at 5 railroad stations is not happening. We don't have enough capital money, and we have more important things to use it with. The developer's opportunity to build that, which could significantly increase our parking availability at the station, while at the same time providing development, better uses of some of the property, as I think the key. And that's why, and that's why our willingness to work with that in that context, with that goal of increasing the amount of parking, is going to be essential.
I mean, the hazard being that you're also permanently capping the parking capacity.
Well, we'll see.
Well, I think
depending on what it looks like.
I think that's exactly right. We have to mix and match. If Helena were here, I think she'd want to stress that. As I said, our paramount concern is the parking.
In the course of doing this, we can maximize our position by being in touch with the LDCs and the IDAs in the area, thereby providing the financing to make this work for the developer.
Right.
They will work with us to do that. They will work with us sooner than working with the developer.
I would question whether that 15% is a number that gives the kind of flexibility that has been talked about here. I think that's way low.
No, I think I said we think it's way low, and the point is that if you set it much higher, you don't get there. I mean, this honestly, I'm trying to describe here both a methodology for making sure that we've looked at all our opportunities and we know what they are and embrace them, and on the other hand, to disabuse the notion, frankly, that we're sitting on a sort of treasure trove of surplus assets, and why aren't we selling it off?
Real estate market, and it's not necessarily just dripping gold at this moment.
Exactly right.
May we have a motion to adjourn the meeting, please?
So move.